All right. Welcome to Crashes and Taxes. I am so glad you are joining me. This is going to be a really exciting podcast because I'm actually going to disseminate some really important information that is not my own. And I always love when we can get information that is worthy of taking up an entire podcast. So last week I did something unusual with you guys, and that was I said, hey, I don't want to give you my opinion. I have an opinion, but I want to just lay out some facts for you. And I just want you to critically think. I mean, that's what we need. We need Americans to turn off the tube, off the phone, off the social media. We need them to start critically thinking about everything that is going on in this country and in the world and think for themselves, does this sound right to me? Don't just take, fact checkers summary and just tell you, oh, there's nothing to see here and move on. Let's actually use the brains that we've been given from our creator and let's process and think through information and decide if we think there's something going on, if we think that there's an issue. I have been talking about the coming economic tsunami, financial tsunami, and I found an article on a great research website, which I will give to you in a second, but I'm going to actually go through this article with you. It is such a phenomenal recapture of everything that's going on that by the end of this podcast, you will be armed with so much more global information at your fingertips than before this podcast that is absolutely worth taking the time. So this is an article that has been written by, and I will butcher the name, I apologize, F. William Engdahl, Engdahl. Engdahl, and he is a strategic risk consultant and lecturer. He holds a degree in politics from Princeton University. He is a best-selling author on oil and geopolitics, and he is a research associate for the Center for Research on Globalization. There is such a thing, Center for Research on Globalization, the CRG. He is a research associate, and again, he has a degree from Princeton in politics. He is a best-selling author on oil and geopolitics. And again, he's a strategic risk consultant and lecturer. Again, F. William Engdahl. And I'm going to go now, and I want to, again, this article is going to be available in, I believe, 50 different languages. It is on the Global Research website, and we're going to go through this. It came out on June the 22nd, and it is, again, worth the effort. And I think as we go through this, you will see. I mostly will just stick to the article. If I have any commentary about a point, if I want to elaborate on something that maybe is written in a way that you guys might not just quickly get it translated, because it is some technical financial topics, I will interject. So this is the name of the article. It is Global Planned Financial Tsunami Has Just Begun. I'm emphasizing that for myself. So Global Planned Financial Tsunami Has Just Begun, dated June 22, 2022. Again, this is the global research site. It can be read in 51 different languages. So feel free to send this to your colleagues throughout the world. They will be able to get it in their language, hopefully. So let's go through this. Since the creation of the U.S. Federal Reserve over a century ago, and that was created in 1913. So if I look up, I'm giving you commentary. Since the creation of the U.S. Federal Reserve over a century ago, every major financial market collapse has been deliberately triggered for political motives by the central bank. Now, again, the author is a political strategist, and so he's writing this from a perspective of politics, and he's letting us know that politics does control finance and economics globally for their own purposes, according to him and his opinion. So he's basically saying has been triggered by political motives by the central bank. The situation is no different today, as clearly the U.S. Fed is acting with an interest rate weapon to crash what is the greatest speculative financial bubble in human history, a bubble it in fact created. Global crash events always begin on the periphery, such as with the 1931 Australian credit stall or the Lehman Brothers failure in September of 2008. This is commentary. That Lehman Brothers failure, obviously, he's mentioning the credit default swaps that were ensuring the adjustable rate bonds that were sold as AAA credit grade bonds, mortgage-backed securities on Wall Street. So I digress and I will go back. The situation is no different today. It's clear the US Fed is acting with an interest rate weapon to crash what is the greatest speculative financial bubble in human history, a bubble it created. Global crash events always begin on the periphery. We already said this, and Lehman Brothers 2008. The June 15th decision, the June 15th, 2022 decision by the Fed to impose the largest single rate hike, 75 basis points, in almost 30 years, as financial markets are already in a meltdown, now guarantees a global depression and worse. The extent of the cheap credit bubble that the Fed, the ECB is the European Central Bank, and the Bank of Japan have engineered with buying up of bonds and maintaining unprecedented near zero, even negative interest rates for now 14 years is beyond imagination. Financial media cover it over with daily nonsense reporting while the world economy is being readied, not for so-called stagflation or recession. What is coming now in the coming months, barring a dramatic policy reversal, is the worst economic depression in history to date. Thank you, globalization and Davos. We're now going into a separate topic on globalization. Globalization, the political pressures behind globalization and the creation of the World Trade Organization out of the Bretton Woods GATT trade rules with the 1994 Marrakesh Agreement ensured that the advanced industrial manufacturing of the West, most especially the United States, could flee offshore, outsource to create production in extreme low wage countries. No country offered more benefit in the late 1990s than China. China joined the World Trade Organization. It's a typo. He put the World Health Organization. I've done that before where I've talked about the international health regulations, the IHR, but I have referred to them as the IFR because I'm used to dealing with the European accounting rules. So this person, he meant the World Trade Organization, the WTO. China joined the WTO in 2001. And from then on, the capital flows into China to manufacture from the West have been staggering. So too has been the buildup of Chinese dollar debt. Now that the global world financial structure based on record debt is all beginning to come apart, this is especially problematic. When Washington deliberately allowed September 2008 Lehman Brothers financial collapse, so his theory is that they allowed Lehman Brothers to collapse. Then they came in and saved Merrill Lynch because Bank of America bought them. But when Washington, D.C., when the government of the federal government of America decided to allow Lehman Brothers to collapse, the Chinese leadership responded with panic because remember, China had invested a lot of money into the United States and commissioned unprecedented credit to local governments to build infrastructure. So what China did was basically authorize their Bank of China to do a lot of infrastructure lending to invest in the country. And that was all commentary. So back to the article. Some of it was partly useful, such as a network of high-speed railways. Some of it was plainly wasteful. You guys have seen the 60-minute ghost city. Probably if you have not watched the 60-minute investigation on China's 1 million person ghost cities. You need to Google that. That is definitely worth a read. That's what's being talked about here. Some of it was plainly wasteful, such as the construction of empty ghost cities in quotes. For the rest of the world, the unprecedented China demand for construction steel, coal, oil, copper, and such was welcome, as fears of a global depression receded. By the actions of the US Fed and the ECB, European Central Bank, after 2008 and their respective governments, they did nothing to address the systemic financial abuse of the world's major private banks on Wall Street and Europe, as well as Hong Kong. We're talking about the central banks, the private central banks. The August 1971 Nixon decision to decouple the US dollar, the world reserve currency, from gold opened the floodgates to global money flows. Ever more permissive laws favoring uncontrolled financial speculation in the US and abroad were imposed at every turn. From Clinton's repeal of the Glass-Steagall, which is a banking act on banking regulation, that was commentary. From Clinton's repeal of the Glass-Steagall at the behest of Wall Street in November 1999, that allowed creation of mega banks so large that the government declared them, quote, too big to fail. That was a hoax, but the population believed it and bailed them out with hundreds of billions in taxpayer money. Since the crisis of 2008, the Fed and other global central banks, ECB, Bank of China, Bank of Japan, Bank of, these are all the ones that we're talking about, have created unprecedented credit, so-called helicopter money. When you hear helicopter money, you're thinking of a helicopter, and money is just being fanned out like that. That's where the name comes from, helicopter money, just fanning out money as if it's nothing, as if it's water, as if it is air. So-called helicopter money to bail out the major financial institutions. The health of the real economy was not a goal. In the case of the Fed, Bank of Japan, ECB, and Bank of England, a combined $25 trillion was injected into the banking system via quantitative easing. This is before Corona. This is not inclusive of Corona. Purchasing of bonds, as well as dodgy assets like MBSs, mortgage-backed securities, over the past 14 years. Now we move to a section called quantitative madness. Here's where it began to go really bad. The largest Wall Street banks, such as JP Morgan Chase, Wells Fargo, Citigroup, and London HSBC, or Barclays, lent billions to their major corporate clients. The borrowers, in turn, used the liquidity not to invest in new manufacturing or mining technology, but rather to inflate the value of their company stocks using so-called stock buybacks, termed maximizing shareholder value. So basically, they used a lot of this low, easy, free credit, low to no cost credit to not invest in3 expanding the economy with new technology, but they performed a lot of stock buybacks. And I've done, this is going back 3 years now, but we definitely talked about how much of all of the stimulus prior to coronavirus went to just pure stock buybacks. Continuing on, BlackRock, Fidelity, banks, and other investors loved the free ride. From the onset of the Fed easing in 2008 to July 2020, some $5 trillion has been invested in such stock buybacks, creating the greatest stock market rally in history. Everything became financialized in the process. Corporations paid out $3.8 trillion in dividends in the period from 2010 to 2019. $3.8 trillion in the 10 years from 2010 to 2019. Companies like Tesla, which never had earned a profit, became more valuable than Ford and GM combined. This is prior to them becoming profitable. Cryptocurrencies such as Bitcoin reached market cap valuation of over $1 trillion by late 2021. With Fed money flowing freely, banks and investment funds invested in high-risk, high-profit areas like junk bonds or emerging market debt in places like Turkey, Indonesia, and yes, China. The post-2008 era of quantitative easing and zero Fed interest rate led to absurd U.S. government debt expansion. Since January of 2020, the Fed, the Bank of England, European Central Bank, and Bank of Japan have injected a combined $9 trillion in near zero interest rate credit into the world banking system. Since a Fed policy change in September 2019, it enabled Washington to increase public debt by a staggering $10 trillion in less than 3 years. Then the Fed again covertly bailed out Wall Street by buying $120 billion per month of U.S. Treasuries and mortgage-backed securities, creating a huge bond bubble. So that's basically what the Fed did through coronavirus. They printed $120 billion per month, and how they did that, how they printed the money, but they bought Treasury bonds and MBS securities. And so their balance sheet right now is around the $9 trillion mark alone. A reckless Biden administration began doling out trillions in so-called stimulus money to combat needless lockdowns of the economy. U.S. federal debt went from a manageable 35% of GDP in 1980. So our debt in 1980 was 35% of GDP. Now it is more than 129% of GDP today. Only the Fed quantitative easing, buying of trillions of dollars of US government and mortgage-backed debt, and the near zero interest rate made that possible. Now the Fed has begun to unwind that and withdraw liquidity from the economy with quantitative tightening, QT, plus rate hikes. This is deliberate. It is not about a stumbling Fed misjudging inflation. Energy drives a collapse. Sadly, the Fed and other central bankers lie. Raising interest rates is not to cure inflation. It is to force a global reset in control over the world's assets, its wealth, whether real estate, farmland, commodity production, industry, even water. The Fed knows very well that inflation is only beginning to rip across the global economy. What is unique is that now the green energy mandates across the industrial world are driving this inflation crisis for the first time, something deliberately ignored by Washington and Brussels and Berlin. Brussels is the head of the EU. Berlin, obviously, Germany. The global shortages of fertilizer, soaring prices of natural gas, grain supply losses from global drought, and exploding costs of fertilizer and fuel, or the war in Ukraine guarantee that at the latest this September, October harvest time, we will undergo a global additional food and energy price explosion. Those shortages all are a result of deliberate policies. Moreover, far worse inflation is certain due to the pathological insistence of the world's leading industrial economies led by the Biden administration anti-hydrocarbon agenda. What they're talking about is the world is using the crass, the inflation, the global coronavirus, the inflation of the monetary policy that has come since to allow gas to become so high that it's unaffordable. And they'll talk to you about buying an electric car because they don't want to do anything about the costs of these really high the gas prices. So let's go back to this. Moreover, far worse inflation is certain due to the pathological insistence of the world's leading industrial economies led by the Biden administration's anti-hydrocarbon agenda. That agenda is typified by the astonishing nonsense of the U.S. Energy Secretary stating, buy electronic autos instead, buy e-autos instead is the quote, as the answer to exploding gasoline prices. Similarly, the European Union has decided to phase out Russian oil and gas with no viable substitute as its leading economy, Germany, moves to shut its latest nuclear reactor, its last nuclear reactor, and close more coal plants. Germany and other EU economies as a rate will see power blackouts this winter, and natural gas prices will continue to soar. In the second week of June in Germany, gas prices rose another 60% alone. So in 1 week, the second week of June in Germany, their gas prices rose 60% in 1 week alone. Both the green-controlled German government and the green agenda Fit for 55 by the EU Commission continue to push unreliable and costly wind and solar at the expense of far cheaper and reliable hydrocarbons, ensuring an unprecedented energy-led inflation. Just a side note, I am not anti-green. I'm not against the green movement. I am against the green movement being foisted upon a world that does not have enough electric cars presently usable to change over to that technology. So it seems to me like they just want to end driving because we don't have the electric car solution right now. And we don't even have enough electricity to, even if the whole world was filled with nothing but electric cars, we don't generate enough electricity. Electricity is generated by coal. Coal is still a fossil fuel. Until we can make clean electricity for cars outside of something non-coal related, I don't see how we're going to create all this new electricity and the nuclear clean energy that electricity can be generated. All of that is being decommissioned around the world because obviously they feel that that's a problem and it's a risk. Let's keep going. I told you this article is definitely massive. The Fed has pulled the plug with the 0.75% of 1%, so 75 basis point, 0.75 Fed rate hike, the largest in almost 30 years, and promise of more to come. The U.S. Central Bank has now guaranteed a collapse of not merely U.S. debt, but also much of the post-2008 global debt of $303 trillion. Rising interest rates after almost 15 years means collapsing bond values. This is such a key point of this article, because as we all focus on equities and talk equities ad nauseum until the cows come home, what did the market do? What did the Dow do? What did the S&P do? What did the NASDAQ do? This article points out that it is the bonds that run the world. So rising interest rates after almost 15 years means collapsing bond values. Bonds, not stocks, are the heart of the global financial system. Debt is the heart of the global financial system. Debt is bonds. Equity is ownership. Debt is bonds. U.S. mortgage rates have now doubled in just 5 months to above 6%. And home sales were already plunging before the 75 basis point latest rate hike. U.S. corporations took on record debt owing to the years of ultra low rates. Some 70% of that debt is rated just above junk status. So your high yield junk status, which is going to be below triple B grade on a bond, is going to be what we call high yield. So anything that's sub triple B is going to be high yield or junk status. So what they're saying is that we've got 70% of debt that is just above high yield. So possibly they're talking about triple B A, kind of bonds. And a lot of that 70% is in that category, not at the triple A and double A level. So that's extremely concerning if it's that credit risky with how much is outstanding. That corporate non-financial debt totaled $9 trillion in 2006. So non-financial corporate debt in 2006 stood at $9 trillion. Today, it is 3x that. It exceeds $18 trillion. Now, a large number of those marginal companies will not be able to roll over old debt with new debt, and bankruptcies will follow in the coming months. The cosmetics giant Revlon just declared bankruptcy. So what this article is pointing out is that when you are doing commercial financing with really low interest rates, and your credit and your company is already just above junk level, just above double B, so triple B and probably A. If you're just above high yield junk, you're going to be triple B and A. So these companies are already not triple A or double A graded paper. They're already somewhat marginal, not junk, but they're somewhat marginal. And then if they're doing all this financing with low rates, they don't have all the capital, unless you're Apple, to just pay off their debt. So they have to, how companies deal with debt is they constantly refinance it. They constantly pay off old bonds with new bonds. Well, if the new bonds interest rates are so much more high because interest rates have gone up so much, you're not going to be having companies that can afford to refinance, especially marginal companies, of which this article is pointing out that 70% of our companies in the United States are just barely above junk status. So these are the companies that will be highly speculative and will not be able to just redo their bonds as they come to maturity. So the highly speculative, unregulated crypto market led by Bitcoin is collapsing as investors realize there is no bailout there. I'm actually a crypto fan. I think that DeFi and decentralized finance is going to, and especially on the blockchain, will be long-term success. So I'm holding my Bitcoin. I'm not advising people to go out and take a Bitcoin position, but I'm definitely holding on. And I believe that long-term Bitcoin will come back, but it is definitely not a short-term investment tool. You have to be able to go into it and you have to be able to stay in for the long haul. We also don't have all of the financial regulations promulgated yet by the federal government through this Biden administration. So things could change. They're definitely looking to regulate the third-party intermediaries. So just coming back to this is this our author's opinion on Bitcoin. And again, it is collapsing. We've seen it collapse. But I would, again, look at holding. And if you think, oh, well, let me go out and buy. I mean, if you're feel comfortable with a long-term hold where you don't know how it will officially be regulated, for sure do that. Last November, the crypto world had a $3 trillion valuation. Today, it is less than half, and with more collapse underway. Even before the latest Fed rate hike, The stock value of the US mega banks had lost some $300 billion of market capitalization. Now, with the stock market further panic selling guaranteed as global economic collapse grows, those banks are pre-programmed for a new severe bank crisis over the coming months. As U.S. economist Doug Nolan recently noted, today there is a massive periphery loaded with subprime, junk bonds, leveraged loans, buy now, pay later, auto, credit card, housing, solar securitizations, franchise loans, private credit, crypto credit, DeFi, and on and on. A massive infrastructure has evolved over this long cycle to spur consumption for tens of millions while financing thousands of uneconomic enterprises. The periphery has become systemic like never before, and things have started to break. The federal government will now find its interest cost of carrying a record $30 trillion in federal debt far more costly. Unlike the 1930s Great Depression, when federal debt was near nothing, today the government, especially since the Biden budget measures, is at its limit. The U.S. is becoming a third world economy. If the Fed no longer buys trillions of U.S. debt, who will buy it? China? Japan? Not likely. Deleveraging the bubble. With the Fed now imposing a quantitative tightening regime, withdrawing tens of billions in bonds and other assets monthly, as well as raising key interest rates, financial markets have begun a deleveraging. It will likely be jerky, as key players like Fidelity and BlackRock seek to control the meltdown for their purposes. But the direction is clear. By late last year, investors had borrowed almost $1 trillion in margin debt to buy stocks. That was in a rising market. Now the opposite holds, and margin buyers are forced to give more collateral or sell their stocks in order to avoid default. That feeds the coming meltdown. With collapse of both stock and bonds in coming months, go the private retirement savings of tens of millions of Americans in programs like the 401k. Credit card, auto loans, and other consumer debt in the USA has ballooned in the past decade to a record $4.3 trillion at the end of 2021. $4.3 trillion in auto and consumer debt. Now, interest rates on that debt, especially credit card debt, will jump from an already high 16%. Defaults on those credit loans will skyrocket. Outside the U.S., what we see now outside the U.S. as the Swiss National Bank, Bank of England, and even the ECB are forced to follow the Fed raising rates is the global snowballing of defaults, bankruptcies amid a soaring inflation, which the central bank interest rates have no power to control. About 27% of global non-financial corporate debt is held by Chinese companies. Again, 27% of global non-financial corporate debt is held by Chinese companies, estimated at about $23 trillion. Another $32 trillion of corporate debt is held by the US and EU companies. Now, China is in the midst of its worst economic crisis since 30 years and little sign of recovery. With the United States, China's largest customer, going into an economic depression, China crisis can only get worse. That will not be good for the world economy. Italy has a national debt of $3.2 trillion, and it has a debt of GDP ratio of 150%. So the US is 129%, up from 35% in 1980. Italy is now at 150% of its GDP. Only ECB negative interest rates have kept that from exploding in a new banking crisis. Now that explosion is pre-programmed despite soothing words from Lagarde of the ECB, president of the ECB. Japan, with a 260% debt level, is the worst. So Japan's debt is 260% of its GDP. It is the worst of all industrialized nations, and in a trap of zero interest rates with more than $7.5 trillion of public debt. The yen is now falling seriously and destabilizing all of Asia. This article is so depressing, but it's reality. And so if you're getting there and if you are there listening and saying, my gosh, I just need to turn it off, what's the point? Don't think that way. we will be much better prepared if we know what's coming than if we are just oblivious and all of a sudden everything overnight switch changes. You see the market coming down, you see a credit, you see you're not able to get money out the bank. I mean, these things could come and all of these people are going to have no idea because they're not on top of it. And the mainstream isn't really covering it and a consolidated way to kind of lead you to, okay, cause, effect, result. Here's where we're moving towards. So that's why I'm taking the time to read this extremely long article so that you guys will have this as a public record and you can forward it and you can get people to get to this site and you can let them read it in their own language. It's phenomenal. So let's just keep going. The heart of the world financial system, contrary to popular belief, is not stock markets. It is the bond markets, government, corporate, and agency bonds. The bond market has been losing value as inflation has soared and interest rates have risen since 2021 in the United States and the EU. Globally, this comprises $250 trillion in asset value, a sum that with every Fed interest rate rise loses more value. A side note here. If I have $100 trillion of bond value globally, there's more than that. But if there's 100 trillion and it's worth 100 trillion and it's got a dividend or it was paying on average a yield of 5%. Let's just say that the yield on the average debt, it's not that high, but let's just say it was 5%. So I have a valuation of 100 trillion at 5%. When they raise interest rates, even 1% to 6%, what happens to that $100 trillion of bonds is it has to effectually now deliver a 6% yield. Nobody's going to buy those bonds from the corporations or the entities that hold them if they're not yielding what the new public interest rate is. So they will be discounted down in value, say to some 80 trillion from 100 trillion, in order to make the 5% yield worth 6%. So you discount the face in order for the yield to be a higher percentage of what those bonds are paying. That is why as interest rates rise globally, the value of bond portfolios come down. It is an inverse relationship. As rates rise, bond values go down. So basically, we're going back to the heart of the financial system is not the stock markets, it's the bond markets. Government, corporate, and agency bonds. The bond market has been losing value as inflation has soared and interest rates have risen since 2021. Globally, this comprises some 250 trillion in asset values, a sum that as every single time they raise rates loses more value. That's why. The last time we had such a major reverse in bond values was 40 years ago under Jimmy Carter's Paul Volcker era with 20% interest rates to squeeze out inflation. 20% interest rates to squeeze out inflation. As bond prices fall, the value of bank capital falls. The most exposed to such a loss of value are a major French bank, along with the Deutsche Bank in the EU, along with the largest Japanese banks. U.S. banks like JP Morgan Chase are believed to be only slightly less exposed to a major bond crash. Much of their risk is hidden in off-balance sheet derivatives and such. However, unlike in 2008, today central banks cannot rerun another decade of zero interest rate and quantitative easing. This time, as insiders like ex-Bank of England head Mark Carney noted 3 years ago, so this is the ex-head of the Bank of England, Mark Carney, 3 years ago said, the crisis will be used to force the world to accept a new global central bank digital currency. We call them CBDCs, central bank digital currency, a world where all money will be centrally issued and controlled. This is also what Davos World Economic Forum people mean by their great reset. It will not be good. A global planned financial tsunami has just begun. And that is the end of the article. So I took 34 minutes and 34 seconds to walk you through this article. We will attach the link to the Global Research website with all of the 51 translations so you can forward this out and on. I'm not saying that every single thing this author says is accurate, but I am saying that I have not fact checked all of his facts, but I am saying that it is actually exactly what I've been explaining to you, that when interest rates rise and the tsunami, I mean, we are really having a double whammy unlike anything we've ever seen before. We have the Fed massively raising interest rates very aggressively. And at the same time, quietly and privately, they're starting to run off their $9 trillion balance sheet, which is the quantitative tightening that the author is referring to. And that means that we do expect a lot of price contraction in markets and bond markets. And we expect a lot of capital to be a lot more expensive, a lot of projects not to be taken up. That is the engine of economic GDP growth on an ongoing basis in any kind of normalized economic society. And we're on the precipice of all of this. And it's very important that people do not look at all of these things in a silo. A food shortage that's happening, 10,000 cows that are dying from heat, which may or may not be unusual. But when you combine that with 95 different food instances, the Abbott labs, closing down and then finally reopening, we're getting our formula from Germany and Mexico. Is this the United States of America or is this a third world country? And then they reopen the formula lab and then they close it down again because it's now, flooded. I mean, it is just the most bizarre a combination of events in history that I've ever heard of. And the coming economic response globally is not going to be pretty. So we need to prepare for what is coming. We haven't been leveraging bonds at our practice for a good 3 years in a direct buy position. There are some structured portfolios and things that do have bonds in them as part of the structure, but as a direct buy for consumer portfolios, we haven't been to bonds for a good couple of years because this has been very clear that we were on a fast road that was going to lead to an ultimate pullback and collapse. And we do know that they want the Great Reset. They want us to move to global currencies, and they're really looking for eventually a kind of one world economic system that everyone can be on. And I don't know how close or how far away that is as part of what they're trying to do. They're definitely trying to push us towards that, but we are going to have a collapse. It's going to derail their system and their process in the meantime. So this is why these are unprecedented circumstances outside anything that we've ever experienced here in the United States. And you have to remember, the Federal Reserve is only 107 years old for us, 108 years old for us. It started in 1913. It was private corporation commissioned by Congress in 1913. And so we only have been in this experiment for 113 years. And it's not going well, and it's about to change completely and forever. So if you're not with an advisor that's talking to you about these things, if your advisor is telling you to stay the course and it'll all work out, if they don't understand this is the biggest tsunami of global convergence of events in the history of probably man's recorded time, then I think that you probably would do better on your own, to be honest. But you definitely need people that understand what's going on in this world. It is a crazy world out there, and I suggest that you take heed and take action. Until next time on Crashes and Taxes, you guys, all the best. Take care.